Hello and welcome, ladies and gentlemen. We have Ashutosh, Bishnoi, MT and CEO at Mahindra Mutual Fund joining in. I have my colleague Ritu Poddar as well, who heads the mutual funds in at Nirmal Bang. Ashutosh, my first question coming to you is especially with regards to what's happening with our markets in tandem with the global markets as well, because the kind of cycles that we are seeing since January itself, it's really overwhelming because you're seeing those bouts, those spurts that come in. Again, that cooling off period comes in. And this is pretty much similar to what we saw back then in 2008. What's the sense that you pick up?
Okay, so let me give you a small historical perspective, if I may. You know, 2008 was slightly different from this, but only slightly. Let me explain why I say that. You know, there is a history to our markets. About 185 years it has existed across the globe. You can mostly see it in the S&P 500 history, right? And over this period of time, this is from 2008, I should say from about 1989. There has been such a huge buildup of leverage in the market, which started to climb with Mr. Greenspan taking charge of the Fed back in the mid 80s. And he figured that he could use the dollar to support the growth of his economy. Now, some of you who are old enough may remember that we had a very quick rise and collapse of what was then known as the internet boom, right? This was in 89, 90, 91, right? We all saw it climb to a new high by 90 and then crash completely, right? And then we were down there. Oh, this is closer to 97, right? Uh, and why did that happen? Because there was so much free money being handed out by the Fed at what is known as unreal or below real interest rates. Real interest rates were negative for a very, very long time in the United States in order to support growth. Now, political uh, expediency demanded that jobs be generated and growth be given rise to. And from time to time, governments do this. They suffer negative interest rates, negative real interest rates. When negative real interest rates happen, there's a very interesting thing that happens. It's like somebody is giving you money for free or even negative rate in a real sense for you to go and do what you want. So in the first edition of the thing, we saw everybody go spend that money in building out empty internet companies. When I say empty, because they actually amounted to nothing in the end. They burned a lot of cash. The cash was free. It came at negative interest rates. So, well, burn it and let's have some fun. A big party happened across the world. It collapsed. Then it reared its head again when we saw it in the 2000 mid 2000s to 2007. And that is the time it actually fueled not businesses and not empty organizations, but it fueled the mortgage market of United States. Now, United States economy is fundamentally made up of few very large industrial activities. Mortgage, home building is probably the number one. Americans build homes like nobody else builds homes, right? And it is the perhaps the largest industry there. And very closely competing with that is automobiles, oil, and arms and ammunition. And clearly, when one of the largest industries was supported tremendously by issuance of free leverage, uh, it collapsed at some point in time. There was no underlying asset, right? And we had all these collateralized debt obligations issued by banks, which came to nothing, and the Fed bought them on its balance sheet and bailed out the economy. Now, when these kind of things happen, when leverage enters the market on a scale which was then at 400 or 500 billion dollars, in order to bail out the economy after that, the Fed started to leverage even more, provide even more free money, and we all know it by the name of quantitative easing, right? And the world followed because the world got worried about the US economy failing, US markets failing. We had become so intertwined with the world, all of us, that asset prices pretty much depended on what happened to the US dollar, right, and the US economy. So everybody cut rates in tandem, provided even more liquidity. So European Central Bank, Bank of England, Bank of Japan, Bank of China does it all the time. I think the only bank that held out at that point in time was the Reserve Bank of India, if I recall correctly, because we took a view saying that we cannot import this problem into India. And we had our own problems in those days. We had a high interest, high inflation. So we didn't do it as much as the rest did. And sure enough, the contagion spread and the leverage went high. And then we saw around 2015-16 that some sense began to prevail over the Fed, and they started to do tightening. But in that period of time, $27 trillion worth of quantitative easing found its way into the asset prices across the world and continue to slush around the world, including in India. I mean, why do you think asset prices in India are where they are? I mean, if you step out of your home 20 years ago, and I unfortunately live in the same home since the 20 years, you see worsening scenario around you in the city. It's less livable. It's the same home, but now it costs 5 times as much. And you wonder why that happened. Nothing improved, but the prices went up. It's essentially leverage chasing assets across the world. When leverage becomes that high, it needs an excuse to puncture out of the system. In 2008, there was a solid excuse, which was CDOs went bad, and so was subprime crisis. But it was a very short crisis in the banking sector. If you recall, it didn't last even 3 months.
Correct.
For the 3 months, it looked like it was the end of the world, but it didn't last because the bailout happened very quickly. And something that would have costed the world $500 billion, maybe a $1 trillion at that point in time to shut down, has now costed the world $27 trillion bailout over a long period of time. All the money went into the markets. And here comes along a new threat, which is not a financial one, which is a medical one. And it comes and pricks the balloon of leverage. Leverage walks out of the market. And what we are seeing today is the deleverage pan out across the world, including our markets. When deleverage pans out, nothing in the stock market or commodity markets or asset prices works in a smooth curve. We know that. Even deleverage doesn't work in a smooth curve. So you will see it jump up and jump down and jump up and jump down. This is the classic deleverage that has happened. From a simple perspective, as asset managers, you literally wait. Once in your life, you might get to see a completely deleveraged market so that you can pick assets which are truly worth it, because they are not feathered, or they are not trumped up or stressed up by the, they are not fattened by leverage. You can see the real asset. You can see its real worth, and that this is the time that we now have.
Right. That's an interesting take that you've given us as well, especially when we backtrack all the events that have happened. But with COVID-19 coming in, it's a very different situation somewhere, as you rightly pointed out. But how do you expect an investor to react to this? Because someone who's already invested right now is facing crisis. Someone who's not really invested, is sitting on a cash of pile, is confused whether I should put in my money right now or should I not.
Right.
Now, a lot of mutual funds have started exploring the pause your SIP button as well. What would you advise them?
Okay, here's the thing. See, there is 3 types of investors right now out there. There are those who lost a lot of money and are scratching the head of saying, how do I recover this loss?
Correct.
I mean, I can't live with this loss. I need to recover it somehow, right? We need to find a solution for them. Number 2 is investors who have sewn off and said never again. And typically these are investors who are who probably have some kind of a cyclical business, and that's about 83% of the workforce in India actually works for its own self, and they're not employed. They're not going to get a salary next month. They've put away money from their monthly cash flows, which are usually lumpy by season, and they put it somewhere and they lost a lot of it, 30 to 40%, in some cases even 50%. And they're not up to it at the game again, and they're saying, look, I have an income stream that looks thinning out. I don't know how much of my business will come back. whatever money I have left, how can I deploy it so that I create one regular income out of it, right? But at least in these tough times which are coming ahead, I should have something which will give me income besides my business, which is going to be highly uncertain. And there is a third set of guys who will say, whatever I have, I need to preserve this. I can no longer take a risk of any kind. If I can just preserve what I have, I'm happy. So there are these three types of people, right? What's the solution? What do you think is going to happen going forward from here? To us, since we prepared for this a little bit earlier, we knew it's been coming because I don't know if you've heard of the school called the Austrian School of Economics.
Correct.
So the Austrians have always believed that money plays a very important role in all markets, whereas the non-Austrians, which is the rest of the world, generally don't count money as a factor, but we are now seeing it pan out differently. The money supply is a huge factor. So we know when the money supply goes crazy, that there will be a deleveraging of the money supply. And therefore, what really matters, what will matter, is the quality of the asset that you invest in. So we at Mahindra Mutual Fund had been anticipating this event for a while because you can never say what will cause it. The last time we came close to it was when Kim Jong-un decided to go nuclear, right? You remember that? 2 years ago, just when Mr. Trump had become president, he was going hell and leather after, I'll go nuke. And so the world thought he will get into a nuclear war and it was all collapsing everywhere. It didn't happen. So anything can cause it, right? It doesn't have to be a financial event. We had no idea that there would be a COVID-19 causing this. But now that it's come, you can see that we were a little prepared. How were we prepared? You make your investment in such assets which are very high quality. What is the meaning of quality of assets? In very simple lay language, if I explain to you, it means any asset, any security that you invest in, which at the flip of a coin, you can convert into cash. You will have no impact cost. You will still take a profit and you will be happy because you can take it, make it into cash when you want it. Crisis needs investors' money to be in such assets because crisis also means that investors rightly should have cash available to meet the crisis, right? Which is what many of us are doing. So if you need a pool of cash, you must have assets that represent ready cash. However, as institutional investors, you can't put your money in ready cash only, right? It's going to earn nothing. It's going to be, today's inflation, it might, but generally you get sub-real returns on cash. So you need assets in every class, which I call ready money assets. These assets can be converted to cash very fast. They exist in equities, they exist in debt, they exist in real estate and every other asset class. The question is, you must apply very stringent filters to be able to identify them. They're not difficult filters. You have to be able to leave your behavior out of identifying. You may like a particular stock because that's your favorite stock. You made a lot of money. Your grandfather, your father, everybody made money out of it. That doesn't make it a high quality company. A high quality equity, for example, in my book is a very simple definition. It's a company that will never need to rely on capital markets for its growth. If capital markets shut down, it doesn't matter. The company will continue to grow. By definition, therefore, these are companies who have very strong business models and very, very long visibility of free cash flows, right? You run a very, very, very valuable research service. Your researchers will be able to find you these stocks very quickly. However, you may not like the look of them because they may be super expensive, right? So what's going to happen? In our view, these kind of high quality stocks, which are ready money stocks or ready money debt assets. And when I say ready money debt assets, these are going to be companies again who are net creditors, or it would be sovereign. It may be not Indian sovereign. It may be somewhere in the globe, right? It may be assets, companies with more assets on the balance sheet, money multiple of assets on the balance sheet than their leverage. Yeah, there are companies and utilities in India whose balance sheets are so fantastically large by way of the asset weight that no matter how much debt they issue, it's never going to cover the asset completely, right? In particularly in utilities, in electrical utilities, you see that. So you need to find those in debt. You need to find the best quality cash. And in my book, the best quality cash is gold. It's always been, right? So best quality equity, best quality debt, best quality cash, best quality real estate. What is best quality real estate? It is super prime. Even in today's market, you can isolate those places in India or anywhere in the world where real estate will still sell at a fantastic premium, even today, even in the shutdown. Because people know the moment the shutdown is over, that's the place to be, right? Now, if you take an example in India, if you own an apartment on St. Gibbs Road on Malabar Hill, the super prime real estate is not only not going to go down in value, after an event like this, it will climb in value because everybody will want super prime. Same thing will happen in equities. Institutional investors across the world will want only ready money assets in their portfolio, nothing else, at least not for a year or two. Certainly not for a year, because they have to report some kind of earning. When are they going to make money? They're going to make money in ready money assets. And so therefore, when you're looking at, when we looked at our fund portfolio a year and a half, 2 years ago, and we said, okay, let's give it a test for this ready money, high quality stuff. And we came up with about 40-50% of the portfolio there, but not 100%. I'm happy to say that at least two of our schemes, we have worked very hard over the last 1.5 years, anticipating that something is going to move in the market. We didn't know when. And these two products, which is the emerging Unnati, which is a mid cap, and Badhat, which is a multi cap, you will see them rise to the top of their peers. For the simple reason is that, not because we are putting fresh money in it, because anybody across the market who's buying new assets is buying those stocks which belong in this portfolio. You can see for yourselves, your brokerage. So all I'm saying is, as individuals, when you're building a portfolio today, you must build a portfolio across assets which are ready money, whether it's equities, whether it's debt, whether it's cash, or whether it's real estate. This is the way forward for people. Will have to pick. The ones who want to recoup their portfolio and want to recoup their losses will have to move their assets, move their investments into ready money equities. That's where the maximum amount of money will be made. It is our considered view that those equities will see valuations at which you and I will have to stop worrying about PE multiples.
Right.
You'll have to come out with some new norm.
Absolutely.
Because they are going to be fantastically valued. Because every bit of money will chase that. So if you think 50-60 multiple on something is high, I guess you get ready for a fantastic value from here. Right? Expensive will get super expensive and hyper expensive. But those will be few. And money is going to be made there in our view. Those who want to only earn a regular income out of their portfolio should look at debt assets of that category. And I was very recently heartened to see that the government is now talking about issuing more debt in some of its PSU asset-based companies, heavy asset-based companies, because those are the kind of assets which are going to give you a very nice regular tax-free income, right? I think people who want to preserve their money should just put it in gold, because that's where the best preservation is going to be offered for the next few years, right? And people who want a good yielding real estate asset, well, they should be able to buy one right now. So to my mind, this is the time you need to revise your portfolio. This is not the time to freeze up. Unfortunately, a lot of retail investors freeze up in this time because they are like, a deer caught in the headlights of a car. They get frozen. You will have to talk to your investors, and I would urge you, anybody who's on this call, please talk to your securities advisor, your broker, your distributor, which is Nirmal Bang here, and they will tell you that this is the time to rejig the portfolio, because you never get assets without deleverage for such a long period of time. And this period will last because, unfortunately for us, this virus is not going anywhere soon, right? This is here to stay. Let's be very clear on this. It may abate, but another viral season will come, and who knows what it will be now like then, right? We'll just have to be learn to be not afraid of this viral as well. We've learned to be not afraid of a much worse disease, tuberculosis. You could catch tuberculosis if you're in the same room with a person, which is not what you will do with a coronavirus. He has to touch you, and then you have to touch your face. And that's the way virus spreads. But tuberculosis spreads through the air, right? And the simple fact of life is that almost every Indian has the tuberculosis bacillus dormant in his genetics. As Indians, it's endemic for us. It
Right.
only needs a trigger to resurface. And last time I counted, 440,000 people died of tuberculosis in India last year, right? That's like 8,500 people dying every week,
Hmm, hmm, hmm.
right? So we've learned to overcome that. So we'll just have to overcome our fear.
Correct.
Government is supporting tremendously to help us, but the fact is only we'll have to overcome this,
Hmm.
and we'll have to address our future and our portfolio, and this is the manner in which we think the future will move. So rejig your portfolio now. 1 year later, you'll kick yourself to say, why didn't I do it then? What was I scared of, right? So investors on this call, please talk to Nirmal Bang. They will help you. Sorry, that answer was too long. Sorry.
No problem. So my next question to you, Ashutosh, will be as you talk about the quality. So, do you see again, the old stories likely to repeat, and the money will chase the same set of stocks, which we have seen, the recent past, that market polarization we talk about so much about, it. So, what's your thought on, or what's your view on the same?
Sure. So you're right. Polarization is going to happen. It may be more extreme this time. However, given the current crisis and what we are going through, we believe that there is going to be a tremendously extra emphasis on a couple of sectors, at least in the near term. You may well imagine that every country in the world has already begun, or if not begun, is beginning to invest a tremendous amount of money, whether privately or through the government setups, depending on the governmental structure in every country, into healthcare infrastructure. Right? It's just become so obvious to the world that we are underprepared. Even the largest and the richest country in the world is facing a problem when it comes to looking after its citizens. Leave alone, lesser prepared countries like our own. But it's become very evident to every government, and it's become very evident to every smart entrepreneur. Right? You saw how quickly some of the industrial houses turned their manufacturing facilities to turn them around within days to start producing ventilators, right, and masks and face shields. So clearly, entrepreneurs see an opportunity in looking after health, as also the entire healthcare sector, including insurance for health. We believe will be a near-term beneficiary, or could even be a long-term beneficiary of something like this to happen. There are others. We've all begun to realize that just like this call that we are doing, that we don't actually need to get down to a five-star hotel and meet 100 people over a drink or tea or coffee. We can do this on Zoom or Microsoft Teams or WebEx. And therefore, companies who are in technology of getting people together will clearly come forward. So these are some of the specific sectors that will come out winners. In the very near term, my anticipation is that, unlike what most people believe, most of the consumers will get into an overdrive of consumption initially. Once you've been sitting at home for 8 weeks or 12 weeks in different parts of the world, the last thing you're going to do is you want to sit at home more, right? You will want to get out, and you will want to do all those things which help you feel more normal as a human being. So you will see a spurt in consumption of those things which people could not consume over the last 12 weeks. And that could include anything. I mean, while people are saying air travel will be restricted by law and you may have lesser people per aeroplane, which we have to still wait to see what happens. But something tells me that, transportation, logistics, Even tourist destinations will probably throw a positive surprise rather than a negative one, because people will just have to get out of their homes and start to feel normal again. And human beings are irrepressible in that. So I guess there is a near-term turnaround you will see in some of those sectors.
Okay, this as you mentioned, like correctly, that yeah, few sectors we can see or recovery sooner than expected. So overall, if we talk about the markets, so what all the factors we are just a start of the month. So what all the factors you see which may affect on domestic as well as the global economy in this month?
Right, difficult to talk about a month because it all depends on a lot of governmental action in different parts of the world. We are seeing, but of course, the global uh, decision seems to be that you can't keep people in their homes for too long, and therefore most of the countries have begun to open up, including our own. I mean, there is some amount of opening up you're seeing. So now the opening up plays out two ways. One way it plays out is that it could make the disease worse,
Mm.
and therefore market sentiment could actually push it down. And the other way it works is that consumption rises, so business rises, and the market sentiment pushes it up. So it's difficult to say what's going to happen in this month, right? But a good guess is that over the next 3 months, all the all the fiscal support that all the large countries have provided to all their large and small and mid-sized businesses, which in the US has reached almost 20% of its GDP, right? In UK, Europe, China already began. Japan is talking about it. All this money is finally going to find its way into the asset markets for sure. And if not, it may not come tomorrow, maybe not in the month of May, but certainly it will be here. It will come because somewhere people will have to use this money into asset prices, and asset prices will recover the moment this support find its way into the
Mm.
markets. And in
Right.
US, for example, 2.3 trillion is already released,
Release,
right?
correct.
And that money is going to find its way into the market. We're not going
Correct.
to be able to stop it. Now, people may pick different markets at different times, but from that perspective, if you ask me, we are sitting pretty good
Mm.
because the problem of the large economies of the world in terms of the disease is the least in our country. While it may seem very large when you're sitting at home and counting numbers every day, but if you put a perspective on the world, we are in the green zone as a country.
Right.
So clearly, my expectation is that liquidity will find its way into India. It will still get treated as an emerging market liquidity,
Mm.
and China will probably be a beneficiary as well.
Correct.
And the narrative on China about manufacturing moving out of China into India is a longer term decision.
Okay.
Markets will not factor that in so quickly. Some governments will have to decide, some entrepreneurs will have to move for the markets to factor that in.
Mm.
But the near term, China is looking good. All the markets are up. It's the only markets that are really going up, right?
Correct. Correct.
Manufacturing is back. So I guess emerging markets will come back into fray. Uh, Next couple of months, I think you should see them coming back into fray.
Right, emerging markets, yes, probably could be the flavor. But as we're talking about liquidity, Ashutosh, the RBI governor also met the NBFCs, MFIs, and mutual funds to discuss the liquidity and lockdown issues yesterday. Anything that you've picked up on that front?
So I think, first of all, I must say that we must thank RBI and SEBI. They've acted in tandem to really, in a sense, bail out
Hmm.
uh, the borrowers, in our case, the mutual funds, because quite
Hmm.
honestly, the event that happened some time ago on the credit risk side, it could have given us a hairy moment had it not been for SEBI
Hmm.
and RBI's timely intervention. But I think they're keeping a very close watch, is the sense I pick up. At this point in time in the banking system, the liquidity is amazingly flush. Uh, the 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 business is not started, so borrowing is not credit is not of taking up,
Hmm.
right? Because you can't start a factory. What are you going to borrow for? Why should you pay the interest? That is one part. The second is, my guess is there will be a differentiation
Hmm.
which I hope will be price based on the quality of credit by the lenders. When I say I hope it's price based, I hope that the not so good quality borrower of a MSME is still able to find borrowings at some price, and he's not shut out of the market, because I think that's the effort that we need to make sure happens. That because that MSME whose business got squeezed in the last 3 months will recover if he has liquidity, but will not recover and will shut down if nobody lends him any money. So if it's a matter of price, I think that's what we should focus on. We should try to make sure that MSMEs get money at some price or the other, uh, and not get shut out of the liquidity windows available to the business. Because the fact remains, like I said, 83% of our economy is those people who are doing running the MSMEs as self-employed people, and the contagion can really the economic contagion can become really bad if they get shut out of the liquidity opportunity. So I think RBI is working very hard to see that that kind of an event doesn't happen. And I think I really take my hat off that this time around we've seen a lot of active participation, a lot of consideration, a lot of listening, a lot of action by on behalf of the regulator to see that the market is at ease. Given, I mean, there are constraints. People will tend to be averse to risk. Risk aversion is going to be a hallmark of any crisis. But as the crisis fades, the risk aversion must also fade, and that's something I think all the regulators are working very hard to see that that happens.
Right. And with all of this as well, where do you think should an investor actually go ahead and put their money? Right now, do you think equities is the best bet? Or do you think it's still advisable to see the debt side of business? Because there is, I mean, usually when you look at debt as well, it is lower risk, lower returns. But seeing how events have been folding out, especially if you have to take Franklin Templeton into consideration, there are a lot of jitters in the market right now. What would you advise on that front?
So let me say this, that this is not today's event, but I think over the last 24 months, what I've observed that, at very low, um, uh, at very low rating level, very high risk level, the that part of the debt market in India has not compensated the investor for the risk that he's taken. Right. So my advice would be that if you are looking at debt, if you need a regular income kind of a profile, you have to pick high quality debt only. Right. And when I say high quality, it is usually not reflecting in the rating. So I'll give you an example of how to analyze debt and how we analyze debt. And if you look at our credit risk fund, is one of the few funds that has sailed through with a very good return, even through the worst of times. And the reason is that when you pick equities, you tend to do bottom up picking, right? So how come everybody doesn't want to do bottom up picking on debt, right? So we do bottom up picking on debt. The first thing that a debt manager does when he starts to look at debt is he talks to the equity analyst, right? To understand the cash flows from an equity perspective, right? And then get into ascertaining those risks which are not evident on the book or in the financial statements. Many of these things happen many times. Yeah, you see events and you start to connect the events in a company's life, and you figure out that this company is not going well on its debt. It may have a technically covered ratio, but the events in the market will not allow to pay. And these are assessments that we need to make as credit managers, which a lot of people don't. And people tend to invest based on rating, and then many times that is not going to be enough. But at this point in time, when you're starting to invest, my advice would be, if you're looking at debt, you must only look at very high quality bonds of companies which have very, very strong balance sheets, both on the asset side. You need asset backed debt, right? That's what you need. And that's the way to look at your building your portfolio on the asset side, on the debt side. I would not walk into the debt market with my, with a swagger at this point in time as an investor. This is a time when the market is differentiating very fast between high quality and poor quality. and therefore only those funds or those portfolios that reflect a higher quality of holding are to be touched at all. Equities, to my mind, continue to offer the best opportunity in the market today. I spoke about how I think that is a good opportunity, where I think that's going to work, how I think multiples will, skyrocket in certain segments of the market. Let me also say this, though we don't offer a product in this area, gold, to my mind, has come back into play. Now, gold, in my view, has always been the best cash there is. You must not look at gold as an asset class. That's a mistake to make. To be an asset class, an asset must have an income. Gold has no income, right? Land gives you rent, and bonds give you interest, and equity gives you dividend. Gold gives you nothing. Gold is just the best quality cash there is. And in times of risk like this, it will work as an insurance policy on your portfolio. You should know that the highest net worth portfolios in the land and across the world usually have the following classification of asset class. And I call these cockroach portfolios because they can survive a holocaust. They have 1/3 high quality equity, they have 1/3 high quality debt, and they have 1/3 high quality cash, which is gold. I can tell you, I personally know and have advised in the past these people and these families who took on these portfolios at my advice. And today they're laughing all the way to the bank because the gold has outrun all the losses and made more money. Right? So when you construct a portfolio for yourself, you should think about this. And you don't have to have physical gold, right? I mean, you are a broking house. I'm sure you can buy ETFs for your customers. There are different kinds of holdings, but I thought this is worth mentioning that this is the insurance policy of your portfolio. It is not an asset class. Do not expect that every year you will get a 8 or 10% return. That doesn't work in gold. So, to my mind, real estate and debt and asset and equities continue to be the main asset classes that you need to look at. And equity, number one.
Ashutosh, just one. Okay. Ashutosh, just and the Franklin episode has happened. So, what's your thought on the same? Whether it's a credit quality risk, was there? That is what this episode has happened, or there was a probably a liquidity risk. Due to liquidity risk, this thing happened. So, what's your thought on the same?
You're asking me to get into a trouble zone. It's a little bit of a problem for me to comment on a competitor. It's not fair. They must have had their compulsions and reasons to invest where they invested. But generally speaking, this has been coming in many portfolios over the last 2 years, right? And I put it down to mislabeling of risk, right? When you go invest, let's take an example in ILFS, and it's rated AAA, and it's backed by equity investors of the highest class. The risk tends to be misread very easily. Unless you're doing the kind of deep research that you do, for example, in equities, right? Unless you do the same in debt, you will never be able to get the risk right. You have to be able to read the risk. It is there in the balance sheet, right? Every collapse that happened in the debt market in the last 2 or even 5 years or 7 years, those particular companies had long ceased to exist on equity portfolios of the same fund houses in which the collapse happened. Now, how do you explain that? That means the equity manager knew something that the debt manager did not bother to look into. I think sometimes that can happen because mislabeling of debt is an easy one to fall into. You have to go into the financial statements. You have to go deep into them. You have to read things like, I'll give you an example of the kind of things we read. We track compensation to the top management, right? And I'll give you an example of a failing that happened, a very spectacular one, where we found that the managing director's cost to company was almost 85% or 90% of the total cost of employees.
Correct.
Right? and this was a leasing company. And we went and spoke to them, and they said, no, we are into office equipment leasing, and we only need peon kind of courier boys to go pick up the stuff and bring it back. We don't need anything else. That sounded very strange to us. How can this be? And spectacularly, that company collapsed, right? It was a South-based company. Because we said, no, there's something wrong here. We track exits of CFOs, right? If there's a high-profile CFO who exits without a job from a company, there is a financial challenge somewhere, right? You have to then go back and read the document, all the financial statements all over again to figure out, what was he uncomfortable with, right? So these are outside the balance sheet events. There's just two examples I'm giving you of how we look at credit. Credit is to be read from the perspective of the user of the company. I'll give you an example of a very large housing finance company, which was at the topmost rating 2 years ago, raised a very large bond offering at 150 basis point above its rated price. Its market rating should have deserved an X price, and he picked up a huge chunk of money, 150 basis point above, and there was a party, I was told. And I said to myself, if an investment banker and my finance team raised me money at 150 basis point higher than my rating, I will shoot all of them. I will sack them. Why will I have a party? If I have a party, that means there is something here which doesn't add up, right? Now, these are events you have to watch. It's not going to be reported in the balance sheet that I spent so much in a party, right? So all I'm saying is, when you're fund managers of debt, you have to go to that extra mile. Now, equity guys do this, right? You go and see the machine. You go and see how much production is coming. You go and see the purchasing manager, and you meet the distributor and the dealer and the retailer, right? Why don't we do that for debt?
Correct.
So what examples I've given you are equivalent events on the debt side, which need to be done. We have actually formalized this in a process. We call it the risk guard process. And we take extra care that no process is jumped. We don't speed up anything. We don't. For example, in the promoter lending case, the share against promoter lending, we had exposure to a very small exposure to one company, and we set a limit saying that if this promoter's lending goes beyond an X percentage, we will want our money back. We no longer want to participate. And we did exactly that. The day we saw the leverage, the percentage go beyond our set limit, we just went to them and said, look, we told you this, so now we please give our money back. And then they were forced to give it back because we had put it in the contract.
Correct.
Now, these are things you can forecast, right? You should know when a promoter is over leveraged, he can shut the company down. That's what is going to happen, because if he's 70% out of his shareholding into lending, the 70% owners can't sell the shares, right? And therefore, the company is going to head for a shutdown. No matter how high the quality of business, it's going to be a fire sale. So these are things you can tell as financial investors. All I'm saying is, I don't know. I refuse to comment on how Franklin Templeton picked its assets, how they managed. But in the end, when it comes on a run, then every debt manager will have a challenge, because they will want to. Sorry, just give me a moment. Since I'm home, there is some distraction. There will come a moment in the exits where you will start by selling your best quality assets. Then you leverage, and people will still want to keep going out, and then you'll be left with something you cannot sell.
Absolutely. Now
that's a classic debt trap story that funds, banks, NBFCs, anybody, this can happen to anybody. So I think it was, fortunately, seems to be like an isolated event. We went through with a fine scan on the other ones. There are a couple of small ones. I think some of them came up actually, who were already struggling.
Right.
But this is not because of the coronavirus.
Correct.
This has been coming for more than 2 years. So don't for a moment believe that this is Yes, it is isolated. Yes, it is fortunately not very widespread because of the actions that many of them took earlier, right? Many of them, at the risk of displeasing even the regulator, took some action and are paying, a price for that, of rescheduling or extending maturities and stuff like that, right? People took action, which were different actions. So this probably ended up being an isolated event. And I would put it down at that. I mean, you can see that it's now waning off. So there's enough liquidity for people to be paid. But I also must tell you that every investor in those funds will eventually get paid, because it's not like a company winding up. A fund winding up means the trust still holds your money, and as and when the assets get sold, whatever money is realized will come to you in proportion to the units that you own. So please don't for a moment believe that it's like a company winding up and gone. It's not like that.
Correct.
So it is a money held in trust, and the regulator is I'm sure as we speak working with the fund house to see that the process is taken to its logical end.
Correct. My last question to you, Ashutosh, is an equity. If we'll talk about, there are much known risk is involved in equity funds, while debt people are not aware about. So what is your thought whether debt uh, it's a perfect space to bring retail investors, or they shouldn't be or they should be a little uh, cautious while investing in our debt mutual funds.
See, you as advisors can actually guide them better on which is a better fund, right? Uh, because when you start looking at what credits a debt fund is holding, you can tell whether this is going to be a good credit or not based on the research. So, should debt be lower risk than equity? Yes, it should be. In substantial portion of the market, which is liquid funds, ultra short-term funds, and low duration funds, this continues to be the story that the risk is far lower than equities. These are at the short end of the market. The liquidity is very, very high. I mean, most liquid funds will be able to liquidate their entire portfolio within 2 or 3 days max. So there is very little risk over there. It is usually a good idea if an investor is starting new to mutual funds and coming from FDs or those kind of places. Then it's a good idea to start them in the shorter duration debt rather than go straight into corporate bonds of long duration at today's market. I would say in today's market, getting into high yield funds is something that you should wait to take the investor in, watch the performance of the fund house, track its 2 or 3 year history, and then begin to trust it or not. In this market, the credit funds that are holding up and doing well, I can tell you, will do amazingly well as you go forward, because the risk is only going to get better from here, right? So you could safely bring in customers into those funds, among which one of us is ours, but there are others. However, people may have a mental block at this point in time, and so please don't fight it. A liquid or a ultra short or low duration is a far easier decision. The difference in return will be 100 basis points, maybe 100 to 150 basis points between credit and maybe low duration, and that may be still worth suffering and not allowing the person to get anxious. But to my mind, for all investors, I am an equity investor, and I'm a highly optimistic equity investor. I can tell you that I've been in this market from even before I started to work, when literally from the day Sensex started in 1979. And I can tell you the amount of money you can create, wealth that you can create in this market, you cannot create anywhere else. This is just not possible. It's humanly not possible. I'll end with a small story that my first boss told me, and I'm going to take his name here, Hemendra Kothari, highly respected gentleman. I was in my background was not in this business. I came from a consumer marketing business, and he told me, Ashutosh, you should join this business for the simple reason that in order to become wealthy, a middle class person can either have a great technology idea that the world buys, or can become a superb entertainer, right? And the people like his entertainment, or you can invest your money in the stock market. He's saying, we don't have the skills to be an entertainer or a technocrat, but we can invest in the stock market. That's pretty much it, where it is at. I'm going to request you to allow me to say that please do look at our funds in the equity side. Even any market, I believe equity funds will support you tremendously. I mentioned two funds in the past, Bharat Yojana, which is multi-cap, and Unnati Yojana, which is mid-cap. These funds have done outstandingly well because we've just kept focus on the simple metric that they should be high quality. Of course, there's a lot of other metrics that go into it, high ROE, high cash to EBITDA, those kind of things. But essentially, what this has done is made sure that investors' money remains reasonably safe. And when the market turns around, they make a lot of money in this kind of portfolios. So thank you very much.
Thank you, Ashutosh, for joining in as well. I mean, great examples that we've picked up from you today. And that's something that will enrich everyone's experience as well in terms of the conversation. But we will try getting you back once again to get more insights with things that we could have already missed in today's session. But thank you very much, Ashutosh, for joining in, as well as Ritu. Thank you.
Thank you.
Thank you so. Thank you.